I'm Ben Rapon. Today is May 10, 2022. This entire video is going to be on the direction of the stock market. I'm going to begin with a quote or a series of quotes from Richard Duncan, economist. And this will set the stage for what I'm going to cover in looking at the stock market and the bond market from many different perspectives. Richard Duncan puts out a newsletter, and he said the following, and I want you to follow this series of quotes from him over a period of time. On March 6, 2021, so this is about 14 months ago, he said, "The injection of so much additional liquidity into the financial markets over such a short space of time, if in fact it does occur, has the potential to cause the speculative frenzy in the financial markets to intensify and drive asset prices much higher." He was absolutely correct. That is exactly what happened when you can trace it back to March of 2021. 6 months later, September 25th, 2021, he said this. So think of the context now. This is about, 8 months ago? Now, however, it appears that the liquidity tsunami has been pushing asset prices higher and is about to come to a very abrupt end. If so, the steady appreciation of asset prices that investors have grown used to is likely to slow down and then stop. The risk of a significant correction in asset prices during the months ahead is probably much greater than most investors imagine. Again, he was absolutely correct. Almost an about face from where he was 6 months earlier, but he saw it coming to an end and then things beginning to collapse. As he said, an abrupt stop. About 3 weeks later, October 15th, he said, with credit growth decelerating rapidly, inflation higher than the Fed had expected, the economy already slowing, sky-high asset prices, and Fed tapering just around the corner, investors should be worried. It's as if he had a sneak peek into 2022 and could see that happening. But he could see it happening because the warning signs were there. The yellow lights, or maybe they were red lights, were flashing, saying, stop, slow down, get defensive, trouble ahead. But the investors and the investment community, financial advisors, ignored it. They don't read guys like Richard Duncan. And if they do, they don't believe in doing anything about it. Unlike the professional investors who manage money. They don't do what the financial advisors do. On December 6th, he said this, asset prices have never been more inflated relative to income, speculation is rampant, and leverage is very high. That was very true in December, 5 months ago. In this environment, if the Fed becomes more aggressive in tightening monetary policy, very bad things could happen in the financial markets. That's called stock market and bond market, especially to highly leveraged investors. That same month, December, 2 weeks later, December 20th, now we're getting close to the very, very top, he said this, the risk of a significant correction in asset prices is high. That risk will steadily increase over the next 3 months as the Fed reduces and then ends liquidity injections that have driven asset prices to record levels. To nosebleed territory would be my words. He was, again, absolutely correct, almost as if he could see into the future what actually happened. A month later, this year, January 20th, the decline had already begun in both bonds and stocks. He said this: the Fed's aggressive acceleration in tightening is likely to put significant downward pressure on asset prices during the months ahead. Bingo. That's what happened. Particularly given how expensive most asset classes have become relative to norms. And then on March 13, a couple of months later, he said investors need to be aware of these risks and fear the Fed. And then finally, last month, about a month ago, April 15th, he said the probability of falling asset prices combined with very weak credit growth means the risk of the U.S. slumping into a recession, and I would say a deep recession, later this year are high. So I'm going to go through some data and some charts to paint a picture of what's going on without bias. I'm not trying to be negative or positive. I'm just trying to report what the data says. It's negative right now, but when it turns positive, I'll give you the positive view as well. Anything positive, I'm going to show it, but it's mostly negative. Let's begin with a dashboard. So I put this together to show different asset classes, different types of indexes that and how they are doing. So I focus on the far right column, which is the year to date. So think about this. Year to date, of course, everything is negative. Everything is red. Bonds, stocks, all asset classes are red. The best of the worst is the Dow Jones Industrial Average, which is down almost 11%. The S&P 500, down 15%. The shocker, the 20-year long-term government bond ETF, TLT, is down 23%. Where is that protection that financial advisors told you that you're going to have against stocks? That bonds tend to prop that up. That bonds are your safety valve, that when stocks go down, bonds are going to go back up. Didn't happen. They became worse than the Dow Jones by a lot, worse than the S&P and the Dow. And then we get into the really tough territory. The NASDAQ 100, down 24%. The technology component of the NASDAQ 100, down 31%. And the ARK Innovation Fund, ARK-K, down 55%. And I thought I would put Netflix in there to show you something on the extreme. Netflix down 70%. And the reason I put these in, these are the things that people were investing in a year ago. These were the darlings. They were making more money than everything else. Well, the further it goes up, the further down it's going to fall, according to economist Hyman Minsky. I look at the 6 major stock market indexes, and then I compare those relative to their 20-day moving averages. There are 4 U.S. indexes, the Dow, the S&P, the NASDAQ 100, and the Russell 2000, which is the index for the 2,000. They're not the smallest companies. They're from the 1,000th to the 3,000th smallest companies. They're small companies, but it's measured in the index called the Russell 2000. So when you look, and then we look at the two foreign indexes: developed countries (EFA) and developing countries markets (EEM). So when you look at these, the Dow, S&P, developed countries, emerging markets, all four are down in all the 20, 50, 100, and 200-day moving averages. All of them are below that, and I'm going to show you some charts later to show you the magnitude of those losses. And finally, the biggest losers are, the worst of the worst, is the Russell 2000, measured by IWM, the ETF IWM, and the NASDAQ 100. And those are down 20 and 24%. Everything below all moving averages. Up above, I put, this was as of May 9th, Monday, May 9th, there were none that had green dots. Last week, there were none. 0 versus 0. One day, we will get a green dot in there, and things will start to change. They will move up. They will probably move up when we don't expect it. And by the way, I think that could happen anytime. If it is preliminary, if it is before the market really finishes collapsing, that usually indicates, there's no guarantees, but usually it indicates a relief rally. And so there's a short-term rally, it goes up, you can call it a head fake, that we're going up, and then investors start to pile on. And then due to lack of commitment, lack of enthusiasm, lack of direction, it collapses again and goes on back down lower. That's the typical pattern. So if that happens, be prepared that there could be a relief rally, and then it will collapse even lower than it is today. That's the reason we don't jump back into the market the first day of a rally or even the first few days of a rally. We wait for it to establish itself as a pattern. Take the stock market. This is as of Monday, May 9th. I take the stock market and break it into the 11 sectors of the stock market. Those that are positive, those that are negative. And here we have two sectors in the market that have some are above their moving averages, or at least energy, XLE, is above all four moving averages, and consumer staples is above 3 out of 4. All the others are below all of their moving averages. The worst are retail, down 24%. Technology, down 21%. Telecommunication, down 21%. And consumer discretionary, down almost 25%. This is a chart. It's a weekly chart. One move equals 1 week. Weekly chart over the last 12 months. And you can see the direction of the market for about 8 months. The black line shows that the market was going up, generally speaking, and then the trend line was broken and it started to go back down, measured by the red line. So for the last approximate 4 months, the market, the S&P 500, has been in a downward trajectory. Earlier I talked about the ARK Innovation Fund, the ARK-K, down 70%. So this goes back about 15 months, back to to February of 2021, and you can see during that period of time, the first third of the chart, ARK funds increased in value, increased 200%. So it went from about 50 to 150 in a period of months. Amazing. So it sucked a lot of investors into it, and then it ran out of juice, and it started its way down, and it has declined 70%, and is still declining. So as you can see from the bottom of the right of the chart, it's in a decline mode at this point. Bitcoin, I couldn't resist Bitcoin. It was only in early November, so this is about 6 months ago. This is a 6-month chart. Bitcoin, which I'm not a fan of, has declined about 50% from 65,000 down to 32,000 in 6 months. How would you like that for an investment? And yet, when it was 65,000, people were saying it's going to 100,000, it's going to 250, etc. Where are those people now? I don't want an investment that's that volatile. That's not. And it's backed, just like the dollar, it's backed by nothing. It has no intrinsic value. Will it become some form of currency in the future? It could. I'm not sure. But as an investment, I think it's a horrible investment when it is backed by nothing and has no intrinsic value and has no earnings. All it is, in my opinion at this point, is hype. When we do a ratio of one index versus the other, we can see the relative difference of those. So, for example, the growth index of the S&P, the growth stocks in the S&P 500, companies like Google, Amazon, Apple, etc., that's the numerator. The denominator is the value companies, and people like, or companies like, Johnson & Johnson, Ford Motor Company, etc. So you can see the first half of the chart, growth, the numerator, is outpacing value. So the growth companies, the ones I named, for example, are going up more rapidly than the value companies. And then about 6 months ago, tables were turned, and value companies, they went down as well. Value companies are down, but they're down less than the growth companies. So from a relative strength standpoint, from a numerator-denominator ratio standpoint, the growth companies have declined and value companies have declined less in approximately the last 6 months. Then we looked, now we talked about this, IWM, the small cap index of the small companies, has been in decline. This is a 14-month chart. So they have been in decline for about 14 months relative to the S&P 500. Now, they have been going down faster than the S&P when the S&P went down. They have also been in decline when the S&P was going up. So they have, generally speaking, been in a decline mode for the last 14 months. Not a good indicator. And in my other video, Jeremy Grantham talked about that when the small cap companies and the technology companies start peeling off and they become more and more oversold, they go into negative territory, and what's left are just some value companies. That's the kind of the forerunner or the indication that the overall market is about to decline. And here we have the small cap companies. The government, long-term government bond ETF, TLT, this is a 24-month chart, and I do this so I can show you a little more of the macro view on it. You can see from its high, about 171, down to its current low, that's a drop of about 30%, about 30%. And then I show the recent trend in the red line. The more recent trend in the last 6 months or so is down more sharply and continuing to head down. And that's an indication that interest rates are going up. Interest rates, the Federal Reserve interest rates, the rate that banks charge each other for overnight rate for money, has been raised to a range of 0.75% to 1%. That's an increase of 75 basis points, 0.75 of 1%. So it was 0 to 0.25. So let's just call it 1%. So if it's 1%, think about this. If it's 1%, the government bond responded by going down 30%. Wow. Or even 24%, 23, 24% just in the last 6 months. That's a lot. So we go to that's TLT. When we go to the Vanguard Extended Duration Government Long Bond, EDV, extended duration, it is down since July of 2020, which was the high, 39%. And again, I show both periods, the more recent period and the longer period. One down about 30, one down about 39. Meaning that this is a reaction or a response to the raising or potential raising aggressively of interest rates. Gold seems to go up and down a lot. It is in high demand, as evidenced by the markup on gold and the difficulty even in getting gold, but it is not reflected in the spot price. So the spot price, reflected by the Exchange Traded Fund, GLD, up and down, up and down. The short-term trend is down at the very end, but the long-term trend is up. Silver, same thing, up and down a lot, long-term trend up, and the short-term trend, say for the last year, has been somewhat declining. And the relationship of those is that silver was in favor for about 10 months, and for about 14 months, gold is in favor. So if it's declining, that represents gold being in favor. Volatility index. The volatility index has been rising, as you can see from the black arrow. The higher that number, the more volatile the market is. And it's now about up in the 30s. It changes throughout the day, but let's just say this chart says it's about 36. I put the red mark on there to show what is generally thought of as, if it's above that number, the market is risky. That number is 24. You can see how much above 24 it is. I'll go over to Asbury Research, and these are their metrics. These are their 6 metrics called the Asbury 6, and all of them are negative. Their cross-asset protection model shows that this compares asset classes. So you can see that in all 3 categories, the weekly, the monthly, and the quarterly view, that bonds versus stocks, bonds are doing better than stocks, or the ETF AGG is doing better than stocks, although both of them are down. High beta volatility stocks versus low volatility is doing better. Large cap is doing better than small cap. The Dow is doing better than the S&P 500, and the S&P 500 is doing better than the NASDAQ 100. Growth versus value, I've already covered that. Value is in favor, definitely in favor, in the last week, month, and quarter. U.S. versus developed markets, U.S. Is doing better than the developed markets and the emerging markets. When you get to fixed income / bonds, government bonds, they're all down. Government bonds are down a lot, but they're not down as badly as the corporate bonds. And so government bonds are the best of the worst, I guess. High yield versus corporate. High yield is doing better, and it's doing very poorly, but it's doing better than the corporate bonds are doing. I think with corporate bonds, there's probably going to be some defaults. It's going to be inevitable, and I think we're going to begin to see that. Short-term versus long-term bond prices, with the kind of decline we're looking at, of course, short-term is going to be more favorable. When we compare the U.S. versus the world, this is about 20 plus countries and some regions, those that are doing the best in all categories, enough that they get a green color, are Chile, South Korea, Thailand, and the Pacific. Now, the Pacific means a group of countries. That would mean countries like Japan, Korea, Hong Kong, Thailand, Malaysia, Singapore, etc., are ones that are probably mostly in that category. I've covered this before. I'll say it again because I want you to have a good takeaway. What can I do? There are things you can do to protect yourself. Stay away from buy and hold investing. Don't buy new real estate now. There will come a time, not now. Secure your income, whatever that means to you. Buy some gold and silver if you don't own some. If you do own some, do you want to buy more? I see no downside to that because I don't see this as an investment. I see this as an insurance policy against the declining value of the dollar. Watch out for your emotions. You can become distraught. And I'll cover that in a minute. Watch out for that. And don't buy what the media is selling. Be wary of who you think you can trust. Enjoy your relationships in a period of time like this. They are valuable. I'll come back to this comment on emotions. I have lost money in the market before. I remember losing money. I sold my company twice. It's a long story. But I sold it first around 2000. And I sold it a second time in 2004 and got a payout during the following 3 years. The first time I sold it, I had some money to invest and I invested it. I made poor choices and I lost money. I lost quite a bit of money. And I remember that. I was not in the industry. I didn't know what I was doing. And so I remember the feelings, the emotions I had of losing quite a bit of money, and it just disappeared like that, just like the last 4 months. And I couldn't believe how much money I had lost and that I had made poor decisions. Why didn't I see that coming? Well, I didn't know what I was doing. That's why, really. But the feelings that go with losing a lot of money are real. I understand them. So if you are feeling that and you talk to your financial advisor and you don't get very satisfactory answers, give me a call. I'd love to hear your story. If you decide to invest with us, you want me to manage your money, we've been in cash or partially invested for this year since January 7th. We are down about 6%, been in cash for about 2 weeks completely, and then we've been quite a bit in cash most of that 4-month period. But we're down about 6% for the year. I would like that to be 0, but we're down 6%. But if you want to invest with us, I would do 3 things. After listening to you, I would put your money in cash. I would have you complete a questionnaire called a risk tolerance questionnaire that tells me how much risk you want to take, how much risk you can tolerate, and I would pay attention to that and how I would design your portfolio. And thirdly, I would design your portfolio so that from here you can get back to where you started and with the amount of risk that you take. And I would do it without bonds because that is not a winning strategy. So I'll leave that up to you. These are hard times. This cartoon depicts that. I want to thank you for watching. Leave questions or comments in the comment section below, and I will put links to the outside articles that I referred to. And there's my number and my email address if you want to contact me. Thank you again for watching.